We are going to start today's 1M by 1M session with a conversation with Sunil Bhargava, who is the founder and managing partner of Tandem Capital. Sunil, welcome to the show.
Hi, Sarmana. Good to be here. Thanks for having me.
Pleasure. Tell us about Tandem. What is the focus of the firm? How big is the fund? What size investments are you making?
So this is we are currently investing out of our third fund, which is Tandem 3. It's a $100 million fund. Our first check is usually $1 to $2 million in late seed deals, where the company is usually raising $2 to $5 million. We invest in companies that have discovered a business or in the process of discovering scale. They are not focused on a particular sector or technology. Instead, we look at the business and like to invest in teams where the timing is right for channel innovation.
So let us talk a little bit about what types of ventures have you invested in, so we get a feel for where is your sweet spot, where is your center of gravity. Industry sector, B2B, B2C. You've talked about stage a little bit. I would like to double click down on the stage, but we'll do that in due course. Let's go one step at a time.
Yeah, so we've invested in a bunch of different markets. As I said, we're not focused on, a particular technology. It's not like we are focused on, enterprise, or we're focused on mobile or Bluetooth and so on. What we are focused on is kind of more your channel and how you go to market and what your product and channel innovation is. So to give you an example, we have a bunch of investments in the construction side, and one of them is a company called Zico, which is out of Seattle, and they're in the smart home space. And there are lots of companies in the smart home space, including companies like Nest and so on. But these guys' thesis was that you have smart switches, which cost $75 to $100, and you have dumb switches, which are the ones that you see most commonly in homes and offices. And the dumb switches cost $2. So when a builder has to put in, 1,000 of these or 100 of these switches in a home, he's not quite ready to take a $100 cost. So these guys have made an upgradable switch. So the builders can put in switches at a very low cost, pretty much close to what their dumb switches would cost. And then when somebody buys it, they can very simply upgrade the home by putting in these cartridges that make these upgradable switches smart. So that is a very different go-to-market. They are very attractive to people building new homes. So we look for innovation like that.
What is the go-to-market for a company like that, to give us a flavor of, what is the go-to-market innovation?
Yeah, so their go-to-market innovation is that, for new home builders, there's a very simple value proposition. If you spend $200 extra bucks per home, which is peanuts when you're building a home, you can now have the ability to say that it can be made smart when somebody buys it. So in the model home, they can show all the smarts, and then if somebody is interested in buying it, they can just say, yeah, we'd like to pay whatever the upgrade fee is, and then somebody who's a minimum wage worker can go in and plug in the modules, or they can do it themselves at a later stage. And it's also future-proofed. If things change, they can push out the Bluetooth cartridge and put in the green cartridge. So what they've done is they've made the selling and installation of smart homes a marketing cost as opposed to a reasonably big building cost for home builders. So that enables home builders to make the decision much more simply, which enables their go-to-market to be much easier than others.
So from their point of view, it's still a B2B deal, though. It's not a B2C deal.
Yeah, actually, in our second fund, we did a lot of B2C companies. In our third fund, it's much more B2B or B2B2C rather than B2C.
Okay. And what trends are you seeing in your deal flow? This is not necessarily what you've invested in, but what trends are you picking up based on what comes to you right now?
So today, the ecosystem for investing in very early stage companies is very robust. This is the phase where companies are building their MVPs and discovering their business. There are accelerators like Y Combinator, Techstars, StartX. There are many $5 to $50 million funds. There's angels, angel lists. So the number of companies that are getting enough of a slug of capital to get their act together and find the initial seed of their business is tremendous. So, when we go to a YC demo day, there are 100 odd companies there, and StartX has another 20, and there's so many different accelerators, and we get things from AngelList and so on. So all of these are, so the quantity of deal flow is exceptional. There's also a lot of market disruption that's going on. There are different ways to reach businesses. There are different ways to reach customers. So there's a lot of opportunity too, but finding that right team with the right timing and right focus is still not easy at all. So we don't make, that many investments in a year. We probably will do about 5 or 6 investments in a year, but we see probably 20 to 30 times that many companies that we meet with, and there's obviously way more than that are out there.
So the question is more about trends in the, let's say 200, 400, 800 companies that you see. What are the trends? What are people working on in your deal flow that are interesting?
I think it's extremely broad. I mean, even if you look at just what we've invested in, we have companies in the construction space, we have companies in the food space, we have companies in the transportation space, we have enterprise infrastructure companies, and this is, so I think, now you hear a lot about blockchain, which is disrupting trust companies. So I think it's a very wide spectrum. I think the best way to kind of get a sense of the breadth of the companies is just go and look at the variety of different types of problems that are being addressed by, a single YC class. So you look at that, and there are 100 companies in there. There are B2B, B2C, global. People are funding. Like one of the companies we're looking at right now is funding student education. So it's all over the place. I don't think there's, and that's why we are focused on channel innovation, because that's kind of the commonality of most of these things, is that the ones that just build a better mousetrap have a harder time breaking out into venture scale companies. The ones that have channel innovation in addition to product innovation are the ones that tend to break out. And because of Facebook and Google and other mechanisms, inside sales is becoming simpler and better. So all of those things are leading to different ways of selling and but you have to get a very clear value proposition for the buyer. You have to know what they're buying.
So would it be fair to say in the types of entrepreneurs that you are interested in investing in, channel innovation is one of the key requirements?
Absolutely, yeah. For us, that is very important. If you're just building a better, another better mousetrap, probably people who understand that particular mousetrap are good investors for that. We kind of look at how is the ecosystem for selling products like that changing.
Yeah. Could you also double-click down on stage for us? You said you put in $1 million to $2 million in a $2 to $5 million round.
Yeah.
So
go ahead.
What are you looking for? Like, if it's a SaaS deal, for instance, are you looking for a certain ARR number, which a lot of funds today have kind of benchmarked on what ARR numbers they would come in at, or if there are other sectors, you have certain metrics that you are anchoring your investments to?
Yeah. So, the first stage, which is prior to where we come in is where the team comes together, you build enough of a product to demonstrate that there is a business here. And you have a thesis as to how this business is going to grow to big size quickly enough. So when we come in, we look at it, so, in SaaS, one would assume that to get to your A round, you need to have probably $1 million in ARR with 50+% margins and a 3x growth rate. So if you're at 300K right now, you've got to be at $1 million in 12 months. So what we look at is, in a marketplace, it might be something different where you could say that, if you had $1 million a month in GMV, you had, about 12 to 15% margins, and same 3x growth over the last 12 months. That would be something that the Series A guys would be interested in. So when we invest, we look at your, what evidence that you have that shows us that you can get to some of these numbers in 12 months. So usually we want to see our deals get from where we are to a Series A in, 9 months on average. Some might get to it in 6, some might get to it in 12, some might take a little longer, but that's kind of what we look at. So what we want to do is we want to kind of fund that level of, so based on what your go-to-market is, what numbers we think the Series A guys would like to see, that's kind of how we look at it. So give you an example.
So you don't consider yourselves a Series A investor?
No, we don't consider ourselves a Series A investor. We usually, because at Series A today, people expect evidence of scale. So they want to see significant growth, 3x growth. That's really important because fundamentally, if you're in a really big market, if you go and tell them, oh, we have a, $20 billion addressable market. And if you're growing at 1x or 2x, there's no evidence that there is actually a really big addressable market. So most of the Series A guys, at least the quality Series A guys, are looking for growth. A lot of the companies that come to us have shown that there's a business. They are very clear on why somebody is willing to pay them money. And they have a thesis that this is how we can expand the growth. They've got a few things in place. Take, for example, one of our companies called Outdoorsy, which was in the RV rental space. When they came to us, they were a marketplace company. They didn't own any RVs. They had 100K in GMV. So they showed that there was, a reasonable, there was a business. But that wasn't an interesting business to any Series A company. But we understood the innovation both on the channel side and the product side. And now, they've done, I think last month they did 20 million in GMV in like about 14 months. So that's the kind of, that's an outstanding example, but those are the kind of things that we are interested in seeing.
So the numbers that you quoted, like a 1 to 2 million investment in a 5 million round, from the universe that we operate in, people are not ready to raise a 5 million round before a Series A usually. So that's what I find a bit confusing in how you position yourself as a fund.
5 million is at the top end. Usually they're 2 to 4 million. I mean, there are some, like we invested in a company called Capability, and then they ended up getting into YC. They raised about 3 million when we put in some money, and now they're going to raise like a $6-7 million round. But the key thing was that they didn't have traction in terms of they didn't have an operational system in place. They built some stuff, they got some prototypes done, they got some pilots going, but they didn't have a clear, thing of scale. So it just kind of, if you have scale, then that's when the E-round guys are very excited about you. It's not so much about the money. The money you may need less, you may need more if you're producing hardware like Deco is, you need more money. If you're doing something like outdoorsy, you need less money. But it's kind of more the stage of the business. So how much have you proven in the business? Have you proven that there's a business? Have you proven scale?
So you are, let me see if I can parse this right, because we are really trying to understand the positionings of the funds who come here to explain their positioning. And right now we have all kinds of permutations and combinations from pre-seed, seed, post-seed, pre-series A, and you're kind of positioning yourselves as pre-series A. So the difference that you are highlighting, I think this is what I understand, is that you are pre-series A in that the company has shown traction but not acceleration. Is that accurate?
Correct, yeah. So we want to show that you can scale, because it's, you can sell a little bit of pretty much anything, but if you fund a company that's not going to grow fast enough into a big market, whether you hit the wall in Series A or Series B, you're going to hit a wall at some point.
Yeah, absolutely. And most companies are not suited to venture capital. Their most hyper growth is not a natural state. They're rare companies they're very rare companies that can achieve hyper growth.
Absolutely, and that's why we see a lot of companies and we only invest in a few. And I don't think that in Silicon Valley sometimes people feel that they have to raise venture money. I don't think that that's right at all. I think it's not an indication that you have a good business. It's just an indication that you potentially have something that could be hyper growth. And when we bet on companies, we are betting on the fact that these founders are signed up for hyper growth and they have a shot at it. And what's going to happen is if they don't, then the investors and the founders are going to be unhappy, which happens to a lot of companies.
Happens a lot. It happens actually to most of the venture portfolios. So very few outliers actually end up successful and make the fund equation work. The rest of them fail to achieve hypergrowth. What about geography? What is your footprint? Where do you like to invest?
So this is kind of our third year of investing. So in our first couple of years, we invested in companies in many geographies. We have teams from Mexico, Canada, Portugal, Eastern Europe, from India. But now we are in this later stage of the fund. I think we need to, we don't have as much time luxury, so we are pretty much focused on the U.S. markets and U.S. companies. But, in investing, if there's a really good company that comes up from anywhere, definitely will listen.
And I imagine you have all these companies, even if they are in the U.S., they often have an offshore operation that is doing a bulk of the engineering. It's a very common trend at the moment, right?
Yeah, I think at our stage, I would say about 25% of the companies have that. If they are from different countries, then definitely they do. If they are from the US, they tend not to, at our stage, have that, but going forward, most of them end up doing that.
But, what we see also is a huge number of companies that are starting elsewhere and then coming to Silicon Valley or to some part of the United States to actually raise later stage capital. And I'm not even saying later stage as in Series B, Series C. I'm talking late early stage capital. Simple, even Series A, Series A. They're building products elsewhere. They're selling from elsewhere for the first couple of years and then coming here to raise money. So that's a very, very big trend at the moment.
Yes, we see a reasonable number of that. I mean, given that, I have connections in India, as probably you do, we see a lot of companies coming out of India that are trying to do that. We haven't invested in too many of those, but I think for a long time, India was focused on the B2C market. It's just over the last year that they've finally focused on the B2B market. So we're seeing a little more of that. But you're absolutely right. There are a lot of people coming in. And we are open to that. We just did a Canadian company that was, that came in. They actually still have their offices in Canada. They haven't moved to Silicon Valley, but they're doing good stuff.
There's a lot going on in Vancouver, especially because the visa situation is a much easier one in Canada.
Yep.
What are some of your notable companies? You've mentioned a few along the way. Have you had exits, for instance, that you would like to discuss?
I mean, we've had tiny exits which are not worth kind of really discussing, but we are too early in Fund 3, we're in the third year of investing, so it's too early for big exits. Some of the things that we did in, I think in Fund 2, like Outdoorsy is going to go out and raise its Series B. They're doing phenomenally well. I mean, obviously, one of the things is that exits now are coming at exits in the form of an IPO or an acquisition are coming at much bigger valuation. But, so some of our companies are getting to the Series B level. A lot of them are getting to the Series A level. In Fund 2, we had a company that was actually based out of India. The two founders were here. It was a US incorporated company, but most of the team was in Bangalore. It was in the gaming space. It was called Bash Gaming. They own the largest bingo franchise in the world on mobile. They were doing about $8 million a month in revenue, and they exited to Game Show Network for about $160 million with only a couple of million invested. So that was a good exit. Another one of our companies was Tile, which makes a little dongle that you can attach to your keys or put in your wallet and so on that helps you find things. That's doing really, really well, but I don't think they are planning to exit. They'll probably try and go for an IPO. We have a lot of promising companies, but nothing exited.
And what is your most promising company in the portfolio currently?
That's a tough question. I think the one which, from a revenue perspective, is furthest along is Outdoorsy. They're at a very...
That's RV rental one?
Yeah, they're at a very high run rate. And it's these marketplace companies, the interesting part about them is that they have a very exponential growth curve. So they start out slow, and then once they hit the formula, then they grow very, very rapidly. Obviously, their margins are not as high as SaaS companies. So the SaaS company curve and the marketplace company curve is quite different.
How do you process the current investment climate where capital is moving further and further upstream? And as I said earlier, we have all these, different blends now of pre-series, pre-seed, seed, post-seed, pre-series A, series A. How does a seed investor, pre-seed investor, or an entrepreneur mitigate the Series A gap? By the time you go through so many rounds of financing, you've already lost so much equity in the process. How do you view all this?
I think, you have to have I think a lot of people, the first thing entrepreneurs should realize is that investors do not invest in products, they invest in businesses. So I have so many people come and talk to me, and the first 20 minutes or 25 minutes of the conversation are about their products. And you've got to get to the business very, very quickly, both in your mind, and that's what you should focus on.
I completely agree with you. We teach all our entrepreneurs to focus on business.
Exactly. So I think if you're focused on business, you have to raise capital to get rid of some business risk. So initially, you want to know what people are, if you have a thesis that people will pay for X, try and validate that thesis and raise the least amount of money to validate that thesis. Now, if we say we have, whichever investors, irrespective of what they say, if you tell them that this is what you do, they'll say, oh yeah, this is kind of the business risk we want to take. So in our case, we say, hey, we are willing to take risk on scale. We're not willing to take the risk on, do you have a business? We used to be, Tandem 1 and 2, and even in the early starts of 3, we were willing to say, hey, if you have a good space and you're a good team, we will bet on finding a business along with you. So I think if you go down that path, the venture community or the investment community, which consists of angels who have, just based on how they're feeling on that particular day, they will listen to your story, and if they like you, if they like the business, for whatever reason, they will write you a check. It's up to you to not raise too much money and reach the next milestone. If you don't reach the next milestone, that's when you really get hit with significant dilution.
Yeah.
If you have, yeah.
And I think, there's a mindset problem that we constantly struggle with, because our work is very early stage work. So there's this obsession with raising capital, and we constantly trying to make them unlearn that obsession and focus on customers. They're more interested in chasing investors than interested in chasing customers, and that is the surest way to lose control of the company and eventually actually end up failing.
Absolutely. I agree with you 100%. It's like you've got to be very maniacally focused on what is it that the customer wants to buy. And most people are very focused on what they want to sell. So they'll come here and tell you why their product is the best thing since sliced bread. They're not telling you about why the customer wants to buy their product. And it's a subtle distinction, but it's a very important
very important distinction.
Yeah.
How do you parse unicorn mania?
I can't say I spend a lot of time thinking about it. On one hand, there's a lot of disruption, both in terms of technology and in terms of how you can get your product or service to people. So there's, we see tons and tons of new things that are disrupting the world. But at the same time, there are new monopolistic companies, Google, Amazon, Facebook, Apple, ones in China, so on, that are also emerging. So the environment is getting tougher and tougher. So I think there's the possibility of having some very large companies, emerge. But on the other hand, these companies like Google and Amazon and so on are extremely have extremely deep pockets and extremely strong execution capabilities. So, the number of unicorns there seems to be a bit nutty. But, hey, rich people can spend their money the best way they feel. So they want to.
I make a very clear distinction between real unicorns and pseudo unicorns. The problem is there are a few unicorns in the market, especially in the private market, that are legitimate unicorns, and it's full of pseudo unicorns that have absolutely no legitimacy whatsoever.
I agree, but I don't, it's always interesting to hear the stories and the business models. They're very educational into what has worked for them in getting traction and so on, and try to kind of build good companies that can benefit from that. And I think your point earlier that don't go seeking venture capital to, if you want to build, like there's a friend of mine, he built just two of them, they built a SaaS company which makes $5 million a year in revenue. There's just two of them. They raise no money. And they have a very nice lifestyle. If two of you are making, their cost is maybe $1 million, so their take home is $2 million each. Hey, that's not a bad thing to do.
Yeah, so, and we have case study after case study of companies that have built incredibly good self-financed bootstrap businesses at this point. It's
and you don't have to even build big businesses. Just build good businesses that. So I think people should think about that clearly, because with venture, it has to be big and it has to be fast. They say patient capital, but it's not that patient.
It's not patient at all. Venture capital is not patient at all. People pretend that it's patient capital. It's not patient capital because the funds are, timed funds. The reason I asked you the unicorn mania question is that, the early stage investors are getting impacted by unicorn mania, right? Because somebody comes in later in the game, loads up lots of accretion preferences. The early stage investors and the entrepreneurs really get screwed.
Yes, yeah. That's true. I think, luckily, we haven't faced any of that yet. Maybe if Outdoorsy gets to be in that unicorn thing, then hopefully we'll get a chance to exit before all that stuff happens.
Yeah, I think that's the answer, actually, exiting at the right time.
Yeah.
So my last question, before we switch to the mentoring part of the session, is, one of my observations, and you kind of hinted to this, is that we are in 2017, and lots of stuff have already been built. Nowadays, there aren't so many wide open opportunities out there, but there are many, many niche opportunities. Some of these businesses need to be built for small amounts of capital, 1 to 2 million, and sold for maybe 10 to 15 million. Some even smaller, maybe invest 250, 500K, sell for 5 to 10 million. What do you think of these kinds of opportunities?
I think they're great opportunities for entrepreneurs. They just have to structure them differently. I mean, if you can, I think there should be a structured way to fund cash flow generating companies. That's something that I'm kind of curious about. I haven't looked at the market. If you wanted to build like this $5 million company that I was talking about, he didn't raise any money, but also he was lucky enough to have the wherewithal to kind of figure out the marketing and all of that stuff. There are lots of entrepreneurs that can build, and it doesn't have to be even a high-tech business. I mean, you could be making.
But that's not my question. I think your point is well taken. There is a whole bootstrapped, business building methodology. We spend a lot of time on that because a lot of the companies that we work with actually should not go and raise money. They should be built, as they're small TAM opportunities. They have to be built without too much capital. The question I was asking was something a bit different, where you kind of you take an opportunity which is not like $1 billion TAM opportunity. It's more like a $100 million TAM kind of opportunity. which is a good tuck-in acquisition. It's better to go to market with products like that through somebody else's channel who actually has the adjacencies, all the core products around which these niche opportunities arise are, you know, sitting somewhere else inside of ServiceNow or Salesforce or Oracle or SAP or somewhere like that. And what needs to happen is you kind of build the product, you know, get customer validation, but then instead of raising huge amounts of money, you basically sell the company very early. That's my question.
There are actually in Tandem, in our first fund, in Tandem 1, that was our model. Mm-hmm. We built companies for small acquisitions, and we invested in 8 companies over 2 years, and by the 3rd year, all 8 were acquired. So it was 100% hit rate. And today, that is happening where, I don't know if you know about like funds like Fabric. You know, these guys are, you know, a couple of entrepreneurs like a Fabric that come out of the space of the networking space. And they understand that marketplace. They built 2 companies in that space, very well connected in that space. They understand that there's these white spaces that you're talking about. And they find entrepreneurs that want to do stuff in that white space. They themselves put in about $1 million into the company up front. And then they help them raise money, they help them figure out the direction to go in, and then they help them get acquired. So I think
Ravi is doing that in Hive, which they actually don't raise any venture capital. They do it very capital efficient and go straight into an acquisition.
Absolutely. Hive is the same. You know, Fabric and Hive, they were in the same office building for a while. So Hive is doing it in big data. Fabric is doing it in the networking space. I think, you know, there's going to be a lot of these that emerge, and rightly so.
Yeah. All right. Well, great talking to you and getting caught up on your activities and how your fund has evolved. When you first told me you were going to do the fund many years ago, you were more in that early stages of thinking through what you were going to do, how you were going to play this game, and it has evolved, obviously, so it's interesting to see your story.
Yeah, thank you.